All right, guys, hope you had a great weekend. Looking right ahead to the week, let's get right into it. So Palantir had a massive pullback last week, obviously off that 30 level down to a low of 2250, bounced back up after hours, pushed up 2455 on Friday. That's after a pretty good report last week. Also, ARK and Kathy Wood were accumulating positions in Palantir around 25 bucks a share. I think this is a great long-term opportunity for any people that missed the run up to 35.45 to build a position in this area and accumulate, because I think the downside, really absolute downside, would be around 15 bucks a share in a worst case scenario when the market pulled back heavily. So let's look at some ideas on how to play it, right? Now, again, I don't think playing it short term is the best way to trade it, but if you want to trade it short term, you can. So looking at the options chain here, a lot of windows open. So here's the option chain here for Palantir. We can see that I think May is the one to target, right? So May right now has a pretty nice asymmetry of risk setup on the 30-40 call spread. So right now that is currently going for approximately $1.25 or so. So risking about 25 to make a maximum profit of 875. That's pretty good asymmetry of risk, right? Your break even is your long strike 30 plus your debit amount of about 25, therefore 31.25. And again, this has almost 3 months till expiration, so you have a long time for it to transpire. And if it goes, well up to 40 bucks, well before May OPEX, you simply turn it into a combo spread. So you could sell perhaps the 50-60 or something like that. And if you did that right now, you'd capture not a lot of premium, right? But again, you're going to sell a debit spread, a credit spread equivalent width to the one that you're long. In this case, you receive about 35, maybe 45 cents here. But if you wait for the pop to 40 bucks, you could sell it probably for around $1.50, which means you're going to have no debit at all whatsoever to make a maximum profit of 10 bucks, right? So no risk to make 10 bucks. That's the key way I would play it if you're willing to go longer term. Obviously, if you want to trade it short term, you can, but there is more risk associated because we can see some more pullbacks prior to a pop back up. So looking at the March OPEX, you can see, again, asymmetry of risk is pretty good even on the call spread for March. So if you went 30-35, for example, you're only risking about 40 cents or so overall to make a maximum of 460, right? That's in 3 weeks' time. So your risk is super low. Obviously, if you manage your risk well and take a small position in this, for example, let's say you allocate 1% of your portfolio to this position, you have upside of over 1,000%, right? Because you can make 460 possibly on 40 cents risk. So if you were to make, maximum profit, perhaps on a 1% portfolio risk, you're making pretty much 10% return plus on your portfolio, risking 1%, right? And again, it's not like it's going to go to zero overnight, right? It'll happen very gradually, roughly at a rate of about a cent per day over the next 3 weeks. So after a week, it'll be down to around 35 cents. After 2 weeks, it'll be down to about 20 cents. And after the last week, obviously, it'll be to zero, right? If it's out of the money, right? But again, we've seen it move pretty rapidly, and this is a pretty cheap spread to look at. I prefer to trade longer term, but if you want to trade shorter term with less risk, dollar-wise, that's your choice. Just an idea here, obviously, too. If you want to finance a trade like this, perhaps, you could also sell cash secured puts out of the money. Again, if you sold, for example, the 20 strike puts for the same expiration date for about 75 cents here, you're collecting an overall credit. So if Palantir stays between 20 and 30, you actually make money still, right? You lose nothing. You need to be okay with owning it below 20 bucks, though, right? So you need to be okay with owning it at around $20 and about 60 cents, 1960 or so, right? So not a bad idea overall. Again, long-term, I'm very bullish on Palantir. Obviously, do your own research and your own due diligence, manage your risk well, trade what you're comfortable with trading, and don't trade with money you can't afford to lose, right? Cardinal rule of risk management, right? Now that's for Palantir. Obviously, if you want a longer-term position as well in stock, cash secured puts are not bad either. For the May OPEX, 15 strike, you're getting about 75 cents over here. So overall, entry point would be around 14.25. That's not too bad overall, considering that it was at about 10 bucks where it based when it did a direct listing, and then it shot up to a high of 45, came back down, and now it's at 24 and change, right? So if you don't mind owning it, and you're patient and you're okay with waiting, 3 months to collect your premium, or to be assigned the stock. Not a bad idea to sell cash secured puts over here. And again, if it pops up early, let's say for example it goes to 30 or 40 bucks, you can buy it back prematurely and collect your premium in advance, right? So that's Palantir, the first one I want to look at. Next one I want to look at was Rocket Mortgages or Rocket Lending, right? Rocket crushed their earning report last week. Phenomenal report. They announced a special dividend of $1.11, I believe it was. I think it's issued to shareholders of note on, I believe it's March 8th, but check that out for yourself to ensure that's correct. That's the ex-dividend date, I believe. So you need to be holding the stock on that date at close in order to collect your dividend, right? Of $1.11, and it'll be paid usually a month after that date, right? So about April 8th or so. That's a pretty large one-time dividend to be paying, and if they pay that, every few quarters based on their massive cash flows, that could be a pretty sweet dividend-paying stock for longer-term shareholders, right? But looking at the chart, and I mentioned a few times now that it's been basing heavily for a while now. Here's the 1-year chart, right? So I mentioned this a few weeks ago that it's been basing between pretty much 18 low points, more so in 20-ish, and a high of like 23, 25. Now I think we're going to see that heavy run up to all-time highs above 35, right? Good dividend, solid quarter. They're just crushing it on all fronts, and I don't foresee that slowing down at all whatsoever. I'm very bullish on Rocket as well. And so let's see how we can trade that too. If you're not holding the stock, obviously you won't get the dividends. So if you're trading options on it instead of the stock, you're gonna miss the dividend, right? Which is $1.11. Also, if you are selling covered calls on your stock as well, be aware that if they are in the money, that being, for example, anything below the current strike price of 22 or so, and the dividend is issued, you will be assigned because whoever owns the call option that you sold, the covered call you sold, they will assign it to you because they want to collect the dividend, and you'll be obligated to pay that dividend to them as well because you'll be short the stock, right? So just keep that in mind as well too. If you're holding the stock itself, you would just lose your position overall, so you wouldn't be obligated to pay the dividend. But if you're selling calls naked, that's where you'd be obviously obligated to pay the dividend, right? That being said, I would say buy the stock longer term instead of just trading options if you want to collect dividends on it, for example. But 1 second, someone's mic's open right now. There we go. But if you want to trade it using options, you can go further out. For example, let's say you go to June, perhaps, right? Options are pretty cheap. In the money calls, 20 strike call options are $3.85, right? You're paying $1.85 extrinsic value on a stock that's 22 bucks, right? So your break even is $23.85 roughly. But if you, for example, sold the 30 strike call against it, or let's say you did a calendar spread instead and you sold the March, for example, the March 25 strike calls against it, right? You can do that right here. You're reducing your debit by about 70 cents or so. So now your break even is 23 or so, right? After March OPEX, assuming it's below 25, then in that case, this would expire worthless, and then you can sell for April, and then for May, and then for June again. Obviously, sell above your break even price to reduce your cost base on your calls, and try not to be assigned on the position, that being the short position. If you are, in a precarious situation where it breaks above your short strike on March, for example, then you're just forced to either buy back for a partial gain, or take a loss on it and then sell your long-term position instead for a profit, right? But as long as you're selling above your break even, there's no chance of losing as it bursts above the short strike, right? So keep that in mind. And then, of course, your maximum risk will be your debit amount overall, right? Alternatively, cash secured puts again, March OPEX, you can see even the 20 strike for March are going for 80 cents. That's not too bad if you're bullish on Rocket Mortgages, right? Or Rocket Lending. You get about 80 cents, which means that your overall cost basis would be $19.20. If you want to own the stock at $19.20 plus get the dividend as well. Obviously, you won't own it before the dividend's issued, so keep that in mind too. That's why I think owning the stock instead is a smarter decision if you want the dividend itself, right? Which is $1.11, I believe, right? But Google it and make sure that I have the dates right. I read a lot of stuff all the time, and I can't remember everything perfectly, right? So that's Rocket Lending. Next, we have Neo. Someone requested that, so I'm looking at Neo as well, right? And right now, NEO, let me see. So we can see on the chart that it is now broken down below the previous area where I thought it would be support 55 area. Now we're looking at support at around 40 area, right? So if you want to own the stock longer term, again, it's a very volatile stock. It's a Chinese EV maker. You can look at the option chain and you can decide what you want to do there. I think that if you're going to trade it right now, the IV is very high. You have to use spreads no matter what. So if you're going to trade the upside on it back up to 55 area, you're going to want to look probably a couple months out, at least April, I would say, OPEX, and then look to the perhaps 50, 60 call spread. Your risk overall here would be about 240 or so for maximum profit of 760. So about 3-to-1 risk reward roughly, break even 52.40 or so. If you want to own the stock itself, there's a lot of premium on cash secured puts, right? So you can sell the 35 strike cash secured puts for April if you wanted to for about $2, and then you're owning the stock at $33 effectively, right? Not too bad, but keep in mind it was a $2 stock last year. I'm not saying it's gonna go back there again, but it has the potential to drop back down to around $25 again if the market really does dump hard, right? So keep that in mind too. For the week ahead, the expected move on NEO. Let me just pull up the chart to see what I think Frankie had that in the chart as well. 1 second. So for NEO, is NEO here? Let me see. No, it's not. No, I don't think it's here actually. No, it's not here. Okay, so let me just price that out right now anyway for the week ahead. So we finished at 47 roughly. So the expected move this week is about $7 in one direction. I'm assuming they have earnings if the IV is that high. Pretty sure they do have earnings actually, if that's the case. So NEO. Yeah, they report on March 1st, which is tomorrow. So tomorrow after market close. All right, so keep that in mind too. Maybe wait till after the event to take a trade on it because the IV will die down and the premiums will be much, much lower, right? So alternatively, you could trade an iron condor on it if you wanted to for Friday, but that's a riskier trade. Looking at that, something like that would look like perhaps. So if the expected move is $7 in one direction, upside is 54, downside is 40. So let's go down to the put side, for example. If you sell this and you buy the 35 put, and then you go to the upside, which is 54, and you sell that and you buy the 59 strike. So you're doing a 5 wide on each side iron condor. You're pulling in a credit of about $1.38, right? Maximum risk is $5 minus $1.38. Maximum risk is therefore $3.62, right? You make max profit if NEO stays between 54 and 40 by Friday's OPEX, right? So in 5 days. Not a bad idea. Again, it could be kind of asynthetic or a way of playing the put side if you want to be a sign on the put side. Again, you're playing a credit over here. So if you don't mind owning it at like 40 less $1.38, not too bad overall. That's my thoughts on NEO. Long term, obviously, it could come down a lot because right now we're seeing the EV market, a lot of cash is coming out of Tesla, NEO, XPEV, QuantumScape this week came down a lot. So you're seeing a lot of bearishness in that sector right now, and that could be sector rotation. You might want to stay out of it for a bit, but that's my own opinion. Obviously, if you're long-term on it, by all means, manage your risk, understand what you're investing in, and understand that it has the potential to pull back pretty hard, right? Next up, we have, 1 second. Next up, we have Blackberry. Okay, so Blackberry was requested too. And Blackberry is looking pretty nice right now in this range right here. So we can see that Blackberry is now, it's been basing in this area over here around $10. And I think $10 is going to be roughly the price floor until earnings, at least. If they have a solid report, which is late March, we may see a pop back up to 15 area again. Given the valuation of the company and what they're working on with regard to self-driving cars and Internet of Things, they're going to be a very, very good long-term play, in my opinion. The asymmetry of risk is phenomenal simply because the valuation on Blackberry is so low right now relative to the possible market they could be in, right? They're worth currently 5.94 billion USD, and they're doing $1 billion in sales almost right now, right? So they're trading at a price sales ratio of about 6, whereas a lot of companies in similar sectors of software infrastructure are trading at price to sales multiples of 20 to 80, right? So even at a price to sales multiple of 20, they'd be trading at pretty much 3.5 times the current price. So about 35 to 45 bucks a share, right? That's a lot of upside on the stock. Downside again, I mean, could it go to zero? Yeah, theoretically, yes. Do I think it's going to zero? Probably not. Downside would probably be around maybe 7, 8 bucks. But I think long-term, the asymmetry risk here is very good. That's why if you want to take a position, you want to look at trading longer term on it, right? So I think, for example, if you want to buy the stock, that's probably the best way to play it because it's a cheap stock. It's 10 bucks a share. But if you want to trade it long term, you can buy the January call options, which expire in about a year. If you buy the at the money contracts, you're spending about $3.60 right now overall, which means your break even is $13.60, right? So you're paying about 36% of the current stock's value in the call premiums, and you're just at the money right now, right? But let's say, for example, you can pull in enough premium on a monthly basis to make it worth your while. Obviously, the risk being that you're gonna miss out on upside if it explodes the upside, right? But for example, right now you can sell the April OPEX contracts, 15 strike, which is above your break even for 56 cents midpoint. So that brings your overall debit down to about $3 now, right? So your break even is now 13 bucks. Alternatively, what if you traded instead in the money contracts instead of buying the stock itself? If you want to risk a little bit less cash, you could buy the $5 call options instead, and those cost you $6. So you're spending half the amount of money to have an equivalent position in the stock, because right now that has a delta of 0.89, which means 0.89 roughly, which means that for every $1 move in the stock, you're going to get about a 89-cent move in the option itself, right? So it mimics the stock movements pretty closely. If you want to mimic exactly, you go synthetic by going long the $5 call and short the $5 put. That would tie up margin for a whole year though, but you can see over here your debit now is down to about $5 on the nose roughly, which is right where the current price is plus the strike price. So 5 plus 5 is 10. And you're paying half the amount of value to trade the exact same asset, right? So you have $5 at risk instead of 10 bucks at risk, and you have the same amount of upside. If it goes to 40 bucks, for example, you're making 35 bucks per contract minus your overall debit. So you're making 30 bucks net profit. If you buy the stock, you have the same upside, but just, double the amount of downside, right? So it might be a better trade trading it with long-term options instead if you have a smaller portfolio, or if you want to be more capital efficient, because again, Blackberry does not pay a dividend, right? So keep that in mind too. Looking out for about a month or so past March, because they report end of March, the expected move for April 16th is about $3 in one direction, right? So upside 13, downside 7. Now, if it pull back to 7, I'd be inclined to buy, a lot of shares around that area, because again, a $7 stock with upside to 45 or so, maybe even higher in the next few years, is a rare commodity. You just need to do your own due diligence and research and understand the potential of the company, right? Because they are working with Amazon now on IV for self-driving cars. They have their QNX software, which is an operating system for IoT devices and self-driving cars as well. And they're working on a number of other things as well too, namely some security features that are pretty important for IoT devices, right? I'll stop there on Blackberry, but again, if you want to own the stock at a cheaper price, you can look at, for example, the at the money puts for April 16th, cash secured. You sell those for a buck 60 midpoint right here. Your effective ownership price on Blackberry stock is 10 minus 160, $8.40, right? Not too shabby at all. You're collecting pretty much a buck 60 on risk of 840. So 1.6 over 8.4. That's a return of 19.05% in 47 days. Not too shabby, right? As long as you don't mind owning the stock. Remember that is a caveat, right? Next, we're looking at the bigger players, Amazon and Apple and AMD. And then we'll finish up with SPY, okay? So Amazon pulled back right down to that 3,000 level last week. And that is a pretty key level. As you can see over the past year, it's been pretty much riding this little trend line to the upside very incrementally over here. I'm not great at drawing lines over here, but you can see that it's riding it, very gradually to the upside, like moderately higher lows and no higher highs yet. But that being said, they had a phenomenal quarter last quarter. And since then, they've fallen from 3,400 down to 3,000 or so last week. I do think it turns around pretty heavily. especially with the new stimulus package being passed. Markets are looking pretty green tomorrow. I think a lot of cash is going to flow out of speculative assets like SPACs, EV sector, for example, and cryptocurrency assets, and flow into like Apple, Amazon, AMD, Microsoft, because they are safe haven assets that are generating superior cash flows, and they're just killing it. All these companies are doing absolutely phenomenal, right? But they're not being rewarded in the stock price. But that means that it's a better opportunity for us because we can see they're doing phenomenally well, and the market is not rewarding them yet, which means that the market has not yet realized the potential there, right? So Amazon is at close to 3K per share. Again, upside on here would be around 3,500, I'd say, in the next few months. Options are very expensive, shares are very expensive. I'm just pointing it out over here, right? I won't delve into it too much more. Next up, we have Apple as well, right? So Apple, again, phenomenal quarter. As you can see, higher low, higher low, higher low, higher low over here as well, right? Assuming we hold this area, right? And we're probably gonna see a higher high from here to here. So in the next 3 months or so, I would expect us to hit around 150 a share. Assuming we don't get that massive pullback I've been expecting, which again, I'll discuss in a sec on SPY. But Apple had a great quarter, as did Amazon as well. And I think that the market's kind of late to realize this, and money will flow back into Apple, and we'll see a push back up to around the 135, 140 area in the next few months. So ways to play that would be to, for example, use, let me just pull up the option chain here. So we can look, again, if we look 3 months out, so we look to April, May, June, right? June OPEX. We can look at doing some call spreads perhaps. Right now, the IV is roughly the HV, so options aren't cheap, nor are they expensive, really, they're kind of average. Put to call interest, 0.66. A lot of calls are being bought over puts right now. And I think upside is to, again, 150 area. So if you want to trade that upside, you could go perhaps for June OPEX, long the 130 strike. And then if you wanted to short for March, you could short the March 130, premium there was what? Let me see. Premium there was 635 midpoint. So your break even is 136.35 there. I may just even go with an easy trade and say, you know what, trade the upside with a simple call spread, right? In this case, if you do, 130, 150, you're risking about roughly $4.20 or so, or $4.10 for a maximum profit of 15.90, right? So you have 4-to-1 risk reward roughly. Break even is 134.10. Not too shabby at all. It was there a couple weeks ago. If it pops back up to 145, 150, you're laughing with a nice profit in your hand. Again, you have almost 4 months to sit on the trade and not really worry about it at all. It's kind of a no worry trade, if you will, right? If you wanted to sell premium in the short term in narrower spreads, you could do that as well. Like for example, if you want to sell perhaps the March, let's see, the March 135, 140. Again, not a lot of premium here. Nah, I wouldn't even do it actually. I would just go long, 4 months out, set it and forget it, not really worry about it. Alternatively, if you want to go longer term, now is the time to buy leaps, right? When Apple's down over 10%, you want to buy long-term contracts. You can buy in the money, for example, 100 strike call options right now. They 1 year out, your break even is about 129 or so if you're buying these contracts here, right? So you're paying about $3,000. Let me remove these contracts here. You're paying about $3,000 overall for your one contract, but if it goes to 160 by end of the year, you're making double your money. And on top of that, your break even is 129, so you can sell above that every month. So for example, for March 19th, you sell the 135, for example, right? Not a lot of credit over here, right? But again, remember, these have 3 weeks expiration and they're 0.09 delta. The probability of them expiring the money is very low, right? So do that every month out of the money as it ascends back up and you're pulling in premium. I'd imagine you could probably get your debit down to around 25, maybe $20 over the course of the year and still have upside to around 160 or so, which means that come year end, you'd have a profit of around 200%. Again, this is a safer, steadier trade. You're risking more for one contract, but your break even is almost where it's at right now. It was there a couple weeks ago, right? That's Apple. Lastly, I'm looking at AMD before we look at SPY. So AMD pulled back a little bit last week down to around 79-ish, and then it shot back up to 87 on NVIDIA's report, right? So you can see it pull back down to the 80 level right there, bounce right off, push right back to the 85 area. Remember, 85 area is a new support area. So you want to see it kind of hold in this area and bounce back up to 95, 100. And it should, because AMD and NVIDIA are both killing it right now, right? So you should see a recovery back up, similar to Amazon, similar to Apple as well. Again, you can trade, longer term if you want in the money contracts. If you want to buy the stock itself, you can buy the stock too. It's not very capital efficient because it doesn't pay a dividend. I prefer to buy leaps that are in the money, for example, risk less money and have the same upside than risk more money and have less upside, for example, right? That's how I would look at AMD in that regard longer term, probably at least 3 to 4 months out, and target the 100 area on that in the next 3 to 4 months, right? Trading it short term, anything can happen. Again, most of the time, if you're trading, same week expiration or 2 weeks out, and you're buying out of the money contracts, expect to lose, right? Most trades like that, you're going to lose on. So don't make a habit of taking gambles short term. Instead, focus on longer term trades that have good asymmetry of risk and high probabilities of profit. That's how you make money in the long run, right? Lastly, looking at SPY before we finish up, I mentioned last week we're due for a nice pullback down to around this level of 360, 350 area. We saw a nice pullback last week down to 380 area. Now, given that they're passing the stimulus bill, the pre-markets are showing right now a pop overall right now in SPY of about 0.9%. NASDAQ is up 1.15% in futures right now, and the Russell is up 1.5%. So expect a nice green day tomorrow as well. But I do still expect a pullback down to this area at some point in time. It would be healthy for the market. It would also give people a chance to jump in, and as there are a lot of new investors that want to buy assets, and so seeing a pullback over here and a chance to buy in on a 10% pullback, perhaps broad market wide, would spur a lot of new money coming into the market, and then push it back up to push to 400, 410 area on SPY, maybe by end of the year, right? So I'm going to end it over here. If you have any questions or comments, drop them below. If you like the video, hit the like button, obviously. If you want to share it with someone else that you think will find value in it, I appreciate that as well. And obviously subscribe too. Otherwise, have a great week, and I will see you guys next week. We're going to cut it right here for